So let me ask you another couple of questions, David. So we talked about the USDA loan, the rural development, the VA, they have a fee on top. FHA is back. They're making a huge comeback. Now, conventional, a lot of people think, so there's the conventional loan. Is that called a conforming loan?
Conforming.
Okay. So that particular loan, it seems as though you don't always need 20% down. Sometimes you can do 5% or 3.5. So that's the question. FHA, conventional.
Yeah, let's talk about some of the...
Yeah, you go for it. You know what I'm saying.
Grants that are available, and that has evolved. I don't want to be political over here, but it has evolved because of necessity. Unfortunately, both administrations, I'm going to give both administrations credit, even though I'm going to get some people upset over here, but both administrations recognize the tremendous problem of affordability.
Well, that's obvious. So, yes, I'm going to put both of them in the same bucket, because if one of them doesn't understand the problem of affordability, that would be insulting.
Yes, it would.
Okay.
And it would be really turning your backs on the needs of society. So there was, and there is going to be more available, but there was a grant in the city of Detroit, for example, that was a $25,000 grant, which was a tremendous boost to many people. The money has run out. I was told that by a bank actually yesterday. I was talking to Fifth Third Bank. So I talk even to retail banks to get my information. There are down payment assistance, and there are, although not enough, you can get clients in with FHA. You can get them. You have to put 3.5% down. Sometimes you can even get that funded with a second mortgage. So I have that ability. So you can get in with just closing costs. And if you can get the seller to pay the closing costs, you theoretically can get someone to move in.
So they're doing that now.
Oh, they are.
Oh, sellers are paying closing costs. Yes. Yeah, me and you with our skills, we can negotiate some great real estate deals for our clients.
So the equity is there. The values are there. In regards to conventional, it's the same idea. The conventional is trying to compete with FHA, and they are also, so this $25,000 is on a conventional program. I know that most zip codes here in Michigan, and Ann Arbor included, will get at least a $5,000 credit. So that's
pretty good. Are there strings attached? Do I have to live in the house for a certain amount of time? Do I have to give the money back when I sell it, or is it a gift?
So in the down payment assistance, there are 2 or 3 different down payments. Some are a lien that's forgivable. Some are repayment, like a second mortgage. So there are different forms of assistance available, but some of them are pure grants where there's no repayment at all.
Oh, okay. I love a grant.
Okay.
Grants are always better. They're the best. Yes.
Those particular loans, Home Ready and some of the other conventional programs, I don't want to get into specific names because each lender has a different name, what they call it, will come with a $5,000 forgivable grant. And the mortgage insurance and the interest rates on those programs are a little bit lower than your regular conventional loan. So it's a really, if you qualify with a slightly lower income, it doesn't have to be ridiculously low, but otherwise you can't qualify for a mortgage. Right. But slightly lower income, and I don't say lower, but slightly lower income, you have a very good product. So lower rates, lower mortgage insurance, and a down payment assistance, and all forgivable. So, and then obviously the idea is eventually when the equity does go up a couple of years, especially when we're talking about interest rates the way they are today, we position people that they can afford it. We don't want to have people who can't afford a house buy a house, but eventually reap the benefits of no mortgage insurance and then a lower rate at some point. And that's the skill of a mortgage broker, that we will keep an eye on those clients for a couple of years, let the house increase in value, and when the mortgage insurance can fall off, we can refinance them, and hopefully in a lower rate, and then eliminate a big part of their monthly payments.
Yeah, sometimes it's like $250 to $500 a month.
Correct.
But here's my question though. On FHA, does the PMI, the private mortgage insurance, does that fall off?
No. It will on certain refinances and certain down payments. So if you put more than 3% down, 3.5% down, it will disappear after about 15 years. But most people will be able to refinance at some point in 15 years to reposition that loan. And I've done it many times. What I do quite often is that when people say, well, you know, I'm going to go back to a 30-year, we have certain lenders who will tailor the mortgage to a 26-year mortgage. So this way they don't feel like, well, I've been paying for 5 years for nothing, and now I'm back to where I was before. Yes, a slightly lower loan amount because they've obviously paid some principal, but they feel like it's an endless process of paying back. There are ways to and there are certain mortgages that are 30-year, 20-year, 15-year, 10-year, which all lenders have, but there are some that can actually cater to something in between. So let's say you've been paying for 3 years, we can do a 27-year mortgage. So this way they don't feel guilty about, you know, going back to a 30-year again.
Well, David, I don't want to bury the lead, so I am a person who is able to buy properties with cash instead of mortgages.
Good.
But, I mean, you have to have so many properties before you're able to do that. And then you have to be willing to downsize. Right. You know, so you go from your big house to your small little condo, and then you're like, oh, I can pay cash now. But when you pay cash for some people own homes, they own them outright, but sometimes they need to refinance to pull a couple of dollars out. And that's a normal thing that people would do that because their kids are going to college, because they want to buy a house in Aruba or whatever it might be, or they have credit card debt that they just really need a relief from, and they own their homes and they're going to take out the equity loan. What are interest rates like for equity loans at this time? Are people still able to do that, or are they having a hard time living that way?
So there's definitely been an expansion. Credit score-wise, income-wise, so it's not just, well, I have to go to Chase, and unless I have a 750 score, I'm not going to get any money. It's nothing against Chase; they do a great job. And my policy with all lenders is, we all need each other. If one part of the spectrum of lending falls apart, we're all in trouble. So, you know, I obviously bank with, and I've had relationships with many banks over the years, and so I employ that. But in regards to my side of it as a mortgage broker, rates are going to have come down. For example, 3 months ago, before interest rates came down, because what the Federal Reserve does has more effect on equity lines than it does on the actual fixed rate mortgages, because it's traded differently. Mortgages are traded against the 10-year, which you'll see every day moves up and down. Obviously, the last couple of weeks it's been coming down in general. Equity lines are tied to prime, and prime is affected by what the Federal Reserve, when they have their meetings and when they lower or increase interest rates. So we have seen rates drop from about 10.5 to about 9. With certain credit criteria, you can actually be at prime at 7.5%. A lot of times, though, it's only for 6 months or a year. There are certain banks that have teaser amounts, but you obviously have to have much better credit scores. We are seeing equity lines where people can qualify even, for example, when someone's used credit cards too much, to either invest or has to wait for a property to sell, and they're using their credit to and they need the equity line to pay that back. We are seeing people even with a 620, 630 credit score getting equity lines, as long as they've got a decent amount of equity. And I've done a few of those in the last 6 months. One of them, a developer in Detroit who was buying land from the land bank, and because he's a builder, he knew which areas would be a very quick return, and because he's a builder, he can buy the land and put the house on there. So things are developing even in the city of Detroit, which is a tremendous positive because it affects the whole state. If your base is struggling, it's going to affect everyone here. Even though Ann Arbor is a little different, but it's a positive tone when things are moving in the right direction.
Okay, so let me ask you another question then. Everyone keeps on talking about the interest rates and they refer back to, oh man, when my parents bought a house, they were paying an 18% interest rate. And that was before the turn of the century. I like saying the turn of the century. So before the turn of the century, we had a particular set of interest rates and they spiked. And, some people have been worried that things might spike now. I don't think that that is the case. I think that we figured those things out so that doesn't happen again. But what I'm asking you is, before the turn of the century, things were a little bit different. What do you expect? What do you think we're going to be expecting now?
So one of the aspects that is not discussed, and this is the economist part of me, not just my knowledge.
I'm an economist too.
There you go.
Yeah, so that's why we talk the same language.
There you go.
Go ahead, David.
So a little bit of background. My family was involved in trading since the 1950s.
Oh, wow.
in pharmaceuticals, because in England pharmaceuticals they had all the IPOs. So I grew up in some discussion, at least in my family, understanding the markets. So one of the things that is not discussed, and it should really be discussed, and if you look not that far long ago in COVID, the government did a massive, I mean massive, refinance of all their debt. As long as the government has this excessive debt, they're paying the same interest rates as we are I call it the big world and the small world. Okay? We're the small world. We're the individuals paying the debt at those levels. But the government is the global problem. Mm-hmm. So as long as they've got unsustainable debt, which unfortunately they do, they cannot allow those interest rates to go too high, because it'll get to a point where even if they print money, they won't be able to pay it. And then, God forbid, we'll have a situation where the government will default on its own debt. So another factor which is important for us, when people were paying 10, 12, 15, 18% interest rates in the 1980s, and I came in 1993, so we were finishing the end cycle of refinancing some of that high debt that we saw. And there was a huge refi boom in 1993 into 1994, and then 1994.
You had a great time. I can only imagine how much it was. You didn't even just cherry picking. You just showed up to work, and you're like, as fast as I can work. That's how much money work fast and accurate. That's how much money I can make.
Right. So, 1994, we had a very difficult pill to digest. Similar to
1994 was when he started saying, "Oh, Mackinaw's not very expensive."
No. So 1994, we had a similar situation as what we're dealing with today, where the Federal Reserve had seen interest rates go from about 14 or 16% all the way down to 4.5%.
Wow.
I think it was about 4.5% when we entered the cycle in 1993, and they didn't know what to do. And obviously, interest rates were not having the correct effect immediately. So 1 month in the middle of 1994. Mr. Greenspan, who was in charge at that time.
I remember Alan Greenspan.
Yep. Decided that he's going to raise rates by not just a quarter or 0.5%. He's going to actually raise them by 4% in 1 month. Well, it was painful. And those days also, unlike today, although it's not been that popular recently, a lot of people had adjustable rate mortgages because you could at least for 3 to 5 years, sometimes 10 years, you could have a lower rate. And if you were not going to stay in that house for long, why should you pay higher, like 8, 9% on a fixed rate when you can get 5 to 6 on an adjustable rate mortgage? Mm-hmm. Well, those adjustable rate mortgages were not capped. So when he raised them, the sky went to the limit.
So I bought my first house in 2002. I never thought about what you said just now. I mean, because I wasn't doing an adjustable rate mortgage. I did get one at one point, sometime in the last 20-something years. Right. But we got the adjustable rate mortgage because we noticed that the stock market was doing better.
That's right.
So I was so the money that we didn't pay to the interest, because we had an interest-free loan for a few years, but I was putting that money in stocks
Right.
and making more money there. But the idea of, I had a 3-year plan. They said, 8 years, blah, blah, blah. I said, no, we'll do this for like 3 years, then we're going to go ahead and refinance.
Right, that's right.
Because I'm scared.
Right, so,
and you said they were uncapped?
They were, yeah. I mean, it was a nightmare.
David, can I really just say really quickly to anybody out there listening, if you work with us, we are not going to let you be so happy about buying a house that you can have just any uncapped adjustable rate mortgage.
Goodness.
My goodness.
No.
No, we have to be smart about these things. Okay,
Yeah.
keep going. So what happened? That's crazy. That was a nightmare.
Yeah, nightmare. So things got heated up. People weren't moving, very similar to what we're dealing with today. Because people are so comfortable in their 4 or 5% interest rates, why should they move and get into... And interest rates actually went as high as 10.2% for a couple of days. Then they dropped to about 9.5%, and then they settled back at 8.5%. At that time, 8.5% was considered a good rate because of what the market had gone through.
Oh, yeah, I got 7 on my first house, and we were like dancing.
Yes.
We were like, wow, we got 7%.
Right.
But I will tell you also after that, so I became a real estate agent in 2005. Okay. But my mom would always buy and sell houses when I was a kid. We were always moving, right? So, at first women couldn't get a mortgage and they couldn't buy a house without a man and all of those things. But in the 80s, my mom was like, you know what, buying houses. And not houses, but we lived in one place at a time. But so I've been in real estate offices since I was 8 years old, but in terms of being out here by myself, spending my own personal money, that started in 2002. Now my clients, I'm always so careful. I generally have really good relationships with my lenders because I need to know that, like you, they're just good people who actually care about people, so that when I'm referring my client to you, I know that I can do my real estate job and find a good house that they want to pay for. And then, you can always make sure that they're not going to be paying more than they can afford. Right. For example, that's one of the things I wanted to ask you about. The taxes adjust after they buy the house in the first year. And not all lenders will talk about that. Now, that's so important.
So let's talk about, and I'm going to combine some of the things I was saying before that I didn't quite finish, which is fine. So
thank you.
When we saw uncapped taxes, because prices weren't as high, back in 1995, if you had a house of $400,000, you had an expensive home. Most were buying $150, $250, $300 was about the limit. And then even $450, I think, was even considered jumbo in those days. Just to show you how things have changed.
Jumbo loans. That's when your loan is over how much money?
Now it's about $840,000.
Okay, that was another one of those words that are going to be down in the comments.
And jumbo over here is important in Ann Arbor just because of the price range is higher. That market, unfortunately, I'm just going to talk about it briefly, has not quite come back to where it used to be. We used to be direct lenders with Wells Fargo, Bank of America, Citibank, and we had the same products as banks. And a lot of times you don't, a good broker at least, will not try to make as much money because the loan amounts are larger. And if you will get, let's say, paid at 1%, that's more than adequate.
I had a lender lose her sale. I was new. It was my second year in the business, and my clients were buying probably a $600,000 house at the time, the most expensive house that I'd ever sold. And the lender was new also, and she did charge them the 1%. They called me up and they said, we're going to have to fire her. And do you have another lender who has 20 years experience that we can work with? Because she didn't know what to do. And I was like, what happened? And I call up this other lender who was my preferred lender at the time, and he just told me, he says, oh, no, she was supposed to adjust that number. Basically, everything that he's passed away since. Brent, loved Brent at Gold Star. But yeah, he picked it up and he ran with it. And he said, oh, no, we're not going to have a problem. You're going to close next week.
Right.
And I was like, unbelievable.
Yeah.
So you're going to be that new guy. You're going to be that guy that just picks it, but you're not going to charge him too much. So
no.
Go ahead and, yeah.
No. It's not good for my reputation.
Thank you.
And everyone's used the same words. I need to be able to sleep at night, but it's more than that. It's especially with and that's a good thing, by the way. With social media, your reputation can be destroyed in minutes with all the goodwill. I mean, it's unforgiving, but sometimes that unforgiveness is a good thing. It keeps people in check. I don't operate worrying about social media. I just try to do the right thing from the day one.
Yeah.
In regards to the jumbo market, lenders are trying to bring that back, and there has been some improvement. Some of the jumbo lending is going to what we spoke about before, the non-QM bucket, the non-qualified mortgage bucket. And it's a good product. Their fees will not be very high. They'll be reasonable. And if they're too high, then obviously the product doesn't exist. The reason why jumbos have not come back is, and again, every product that was given to brokers, if it was treated and correctly, we wouldn't have had the fiasco of 2008. But that's unfortunately not what happened. So we had a thing called option arms. I only sold 3 of them, and my clients were in Orchard Lake, and we were doing loans of $1.6 million. But they could obviously well afford the fluctuations with those loans, and a lot of that payment you were saying, the surplus money was going into the market, and they were able to, and then they would recoup some of the money every year at the adjustment and pay down the principal or pay down the interest because the money had been in the market. Unfortunately, those products are no longer available, or at least I haven't seen them. But there is a increase in the secondary market that is coming back from places like California, where they seem to have the pulse on those loans. And I do talk to them every couple of months to see what's happening. There are some people in the industry that are really on top of that situation, but I do see some improvement in that area. This is David Shepperd. I'm from Great Lakes Mortgage Brokers in Southfield, Michigan. I also have 2 other companies. David Shepperd Inc. is my insurance company, which is property and casualty, and I do some other consulting work also for in general for real estate.
Thanks, David.
You're welcome.
Glad to have you here today.
Thank you.
Later on, we'll be back with another segment from the David Shepperd series.
Yay!